Welcome to our deep dive. ESG investing is a hot topic these days, so we're really excited to dig into this book, Invest for Good.
Yeah, Mark Mobius, Carla von Hardenberg, and Greg Konieczny, they really bring a lot of experience to the table, especially with emerging markets.
Yeah, you shared this book with us, and emerging markets is something we haven't really tackled a lot yet.
It's an area that's often misunderstood or even overlooked, but it's got so much potential, and, the authors, they really make a strong case for that.
So we want to go beyond just the headlines with this deep dive
Mm.
and pull out some of those, surprising or counterintuitive insights from the book.
Yeah, the stuff that maybe you haven't heard before or haven't thought about in this way.
Exactly. And hopefully spark some new ideas about how we can approach our own investments, right? Because we all want to invest for good. But how do we actually do that effectively?
Right, and that's where this book, I think, really shines. They give us some practical guidance, but also challenge some of our assumptions about ESG and how it plays out in these, less familiar markets.
Yeah, and I think one of the first things that really jumped out at me was their emphasis on governance. Like from the get-go, they highlight it as the most critical element of ESG.
Yeah, they even compare it to, the Apostle Paul's writings governance as like the bedrock of everything.
Okay, so let's break that down a little bit because, we all know governance is important. But what makes it the driving force for the environmental and social aspects?
Well, they argue that without solid governance structures in place, environmental and social initiatives often lack substance. It's like building a house on sand without a strong foundation. The whole thing is vulnerable.
So it's not enough for companies to just say they're doing good.
Yeah,
They need the systems in place to actually follow through.
exactly. And this is where it gets really tricky in emerging markets because sometimes what constitutes good governance can vary widely based on local customs and context.
Right, like different cultures might have different norms or expectations.
Exactly. And they share a story about a Nigerian oil refinery where locals were siphoning crude oil as a form of security
Yeah.
system.
Wow, that's fascinating. It really challenges our assumptions about what responsible behavior looks like in different cultures.
Right. It highlights the need for a nuanced understanding of ESG. It's not a one-size-fits-all checklist.
Now, the book also digs into the rise of ESG investing, which actually has roots going back decades.
Hmm.
Think about the divestment campaigns against apartheid South Africa.
Yeah, those were early examples of ESG in action, investors using their power to push for social change.
And today, the Global Sustainable Investment Alliance reports trillions of dollars being managed under ESG principles.
Mhm.
So it's gone mainstream. But the book argues that it's still evolving, particularly in emerging markets.
Which makes sense. These markets are often more reliant on foreign capital and thus more sensitive to investor pressure on ESG issues.
They need the investment, so they're more willing to adapt.
Right, and that pressure can lead to some really positive changes. The authors highlight the concept of positive externalities, essentially the beneficial side effects of companies addressing environmental concerns.
Like Tesla, their sky-high valuation, despite not always being profitable, shows that investors are banking on the long-term potential of ESG-focused companies.
Exactly. They're seeing something beyond the immediate financials.
It's not just the Teslas of the world either. They mention a company in Beijing that's developed reverse vending machines for plastic bottles.
Oh, yeah, they're making a profit while cleaning up the environment. Pretty cool.
That's a cool example. It shows how innovation and sustainability can go hand in hand, especially in a rapidly developing economy.
And that brings us to the social aspects of ESG, which are especially critical in emerging markets where global supply chains can sometimes obscure working conditions.
Yeah, it's a sobering reality. The book contrasts the Rana Plaza tragedy in Bangladesh, where a garment factory collapse killed over 1,000 people, with the Ali Enterprises fire in Pakistan.
Yeah, where there was actually some progress in securing compensation for the victims.
Right, so it shows the complexities of social issues within these markets. There are definitely challenges, but also signs of progress.
Absolutely, and consumer pressure is playing a role too. Things like the California Transparency and Supply Chains Act show how we as consumers can push for greater accountability.
It's about using our purchasing power to drive change. They also mention a positive development micro-apartments being built in Manila to provide affordable housing for young workers.
Oh, yeah, that's a great example. It cuts down on commutes, reduces pollution, and improves their quality of life.
So win-win on multiple fronts. It seems like those positive externalities are popping up everywhere when you dig a little deeper. Okay, so we've touched on the environmental and social aspects, but let's circle back to governance, that cornerstone the authors keep emphasizing.
They're adamant about this without good governance. The E&S can be shaky at best. They use the example of a Romanian oil refinery that had all these hidden pipelines siphoning off oil.
And this was cleaned up by a foreign investor, right?
Exactly. They came in, instituted better governance practices, and ended up increasing the refinery's value while also improving the country's reputation.
It's a great example of how good governance can be a catalyst for positive change on multiple levels.
Absolutely. And it makes you wonder how much untapped potential there is in these emerging markets if governance is the key.
That's what the authors are getting at. They highlight the Corruption Perceptions Index and its strong correlation with a country's GDP. The less corruption, the more economic growth. It's pretty clear.
So good governance isn't just about ethics. It's about unlocking economic potential.
And sometimes our assumptions about governance in these markets can be wrong. They share the story of Turkish Airlines and the government's willingness to appoint independent directors, something they didn't expect.
It reminds us to avoid sweeping generalizations. Each market, each company has its own unique story.
Okay, so we've established that governance is critical. But what about the role of investors themselves? How does that play into this whole ESG landscape?
Well, the book dives into the debate between passive and active investing. Passive investing, as you know, is essentially tracking an index. But the authors argue that passive investors relinquish their power to influence companies on ESG issues.
They're basically along for the ride, right? Whatever the index does, they do.
Exactly, and they raise some pretty pointed critiques, suggesting that passive investing could actually be harmful to capitalism and innovation in the long run.
Wow, so they're advocating for a more active approach?
Definitely. They believe investors have a responsibility to engage with companies, to hold them accountable, and to use their influence to drive positive change.
So it's not just about picking the right companies or funds, it's about being an active owner and using your voice to push for positive change.
Exactly. And that brings us to another fascinating area the book explores: impact investing.
Impact investing. That's where investors specifically target their investments to generate both financial and social returns.
Right. Exactly. It's about aligning your investments with your values, putting your money where your heart is. The authors discuss the Bridges model of impact investing, which categorizes investments based on their impact and financial objectives.
The impact first category is particularly interesting. These are investors who prioritize impact alongside financial returns. It's not just about making money, it's about making a difference.
And this approach is gaining traction. We're seeing major commitments from foundations like Ford and the Bill and Melinda Gates Foundation. They're putting serious money behind this idea.
They also share the success story of M-Pesa in Kenya. It's a mobile phone-based financial system that's transformed how people in Kenya access financial services.
It's a classic example of how impact investing can drive real change. M-Pesa has lifted countless people out of poverty, especially women.
It's incredible to see technology being used in such a powerful way. But let's be real, measuring the impact of these investments can be tricky. How do you quantify social good?
That's one of the biggest challenges in the impact investing space. It's not always easy to measure non-financial returns.
The authors mentioned various initiatives working on this problem, developing better impact measurement tools, things like the IRC and the SASB.
And they highlight some interesting ideas like Acumen's lean data system and a proposal to use scientific frameworks from public health and environmental science to measure impact.
So it's a work in progress, but at least there's a growing recognition that we need to be able to measure what matters.
Absolutely. Okay, we've covered a lot of ground in this first part of our deep dive. We've seen how governance underpins everything in ESG, how emerging markets present unique challenges and opportunities, and how both passive and active investors have a role to play.
And let's not forget the power of impact investing to drive real change. But before we move on to part two, we want to leave you with a question to ponder. If ESG investing is truly about making a positive difference, can it ever fully reconcile the pursuit of profit with the needs of people and the planet?
It's a question that gets to the heart of ESG's mission and tensions it sometimes faces. We'll explore this further in part two. Welcome back to our deep dive into ESG investing.
Yeah, picking up on that question we left you with, can ESG investing really balance profit with the well-being of people and the planet?
It's a tough one, right? The authors use this really striking historical example to kind of illustrate this tension.
Oh, yeah. What's that?
They talk about the East India Company and its opium trade in China back in the 18th and 19th centuries, driven purely by profit. They flooded China with opium.
Yeah, despite the devastating social consequences.
Exactly. It's a stark reminder that profit and ethical considerations haven't always been, aligned.
For sure. But what's interesting is this concept they introduced called pro bono investing.
Yeah, it's like pro bono work in law or
Mm.
medicine, investors dedicating resources to ventures that might not offer market rate returns.
Deliver a huge social impact.
Right. They even use that story of the advertising executive who helped a blind beggar by simply rewording his sign.
Oh, yeah. Small change, massive impact.
Right. Applying that to finance is pretty powerful.
Feels like a more proactive way to address social issues rather than just avoiding harm.
But they raise a thought-provoking point, a potential contradiction within impact investing itself.
Oh, really? How so?
Well, if an impact-focused venture becomes really successful, generating those market rate returns or better.
Should attract regular investors, right?
Exactly. So the argument is that impact investing should focus on ventures that might struggle to get traditional funding.
Because their financial returns are less attractive, but the social impact is huge.
Exactly. It's about filling a gap, supporting ventures that prioritize impact without sacrificing financial sustainability.
Makes sense, especially in emerging markets where capital markets for startups and smaller companies can be less efficient.
Right. And there's a perfect example in the book, a microfinance institution they invested in.
Oh, yeah. Tell me about that.
They use mobile phones and apps to manage accounts, bringing financial services to people who've never had access to traditional banks.
Like that leapfrogging concept we discussed earlier.
Precisely, M-Pesa in Kenya is another prime example.
Yeah, empowering people in a tangible way.
Absolutely. Okay. But let's shift gears a bit and look at the broader landscape of ESG investing. The authors make a distinction between those who actively engage in emerging markets and those who take a more hands-off approach.
Okay, so who are they talking about?
They're talking about large funds that rely on ESG indices and delegate their oversight to proxy advisors.
Okay, so they're not really getting their hands dirty.
Not really. They argue that this passive approach, while cost-effective, can limit investors' understanding of companies on the ground.
It's like the difference between reading a travel brochure and actually experiencing a place firsthand.
Perfect analogy. Active engagement means gathering firsthand knowledge, building relationships, and advocating for change.
They even call themselves the infantry of ESG investing.
Yeah, in the trenches getting their boots dirty.
I like that.
Which allows them to truly identify the risks and opportunities specific to each market. They point out that while ESG data is evolving, there's still a heavy reliance on basic scoring systems, especially in emerging markets.
Yeah. Understandable though, right? Accessing reliable data and conducting in-depth analysis of these markets can be tough.
Absolutely. But the authors argue that we need to move beyond simple metrics and strive for deeper understanding.
So better data, more transparency, more nuanced analysis.
Exactly. And they also continue their critique of passive investing, suggesting that it could hinder innovation and reinforce the status quo.
Interesting. So by simply following the index, you might miss out on opportunities to push for real change.
That's the argument they're making.
Brings us back to shareholder activism, that TPSA orange rebranding in Poland.
Right. Even as minority shareholders, they use their influence to advocate for fairer practices.
Yeah, it highlights that responsibility we have as investors to hold companies accountable.
Not just for profits, but for their environmental and social impact as well.
Now, speaking of accountability, the authors delve into a related issue, sovereign debt defaults. They share the story of Argentina's default in 2002.
Oh, yeah, and the legal battle that followed.
What a mess. It really highlights the importance of strong governance and transparency at the national level.
Definitely the ripple effects of a sovereign debt default are huge.
And on that note of larger forces at play, let's talk about millennials and their role in shaping the ESG landscape.
Yeah, they're often seen as the driving force behind the growing interest in ESG investing.
I mean, it makes sense. They're the ones who are going to inherit this world.
Right. The authors describe millennials as a pressure group with a strong ESG agenda. They demand transparency and accountability from companies.
And they vote with their wallets.
Exactly. It's that intersection of consumer activism and finance, and it's working companies are realizing they can't ignore ESG concerns.
They even mentioned Coca-Cola's pledge to recycle all its packaging by 2030.
As an example of companies responding to this pressure.
But are they actually going to do it?
That's the question, right? The authors caution against taking such pledges at face value.
So look beyond the PR demand evidence of real progress.
It's about action, not just words.
Which brings up the challenge of measuring impact, especially when it comes to environmental and social initiatives.
Yeah, the authors point out that traditional financial metrics don't always capture the full picture.
So we need better tools to measure what matters.
They discuss initiatives working on this, but acknowledge it's still an evolving area, and they touch upon a tricky topic, greenwashing.
Oh yeah, companies making misleading or exaggerated claims about their environmental or social performance.
It's something investors need to be wary of.
Reinforces the importance of due diligence and critical thinking.
Absolutely. Don't just take things at face value. Dig deeper, ask questions, and be skeptical.
Now, does being good actually translate to good returns?
That's the million-dollar question, right?
The authors acknowledge that ESG-compliant companies and funds have generally performed well.
But they caution against expecting immunity from market forces. They point out that even green investments like renewable energy have experienced periods of underperformance.
Right. It's a reminder that ESG investing isn't a magic bullet. It's about more than just financial returns.
It's about aligning your investments with your values and contributing to a more sustainable and equitable world.
And in the long run, they believe companies prioritizing ESG factors will be better positioned to navigate the challenges of the 21st century.
They see a growing consensus around environmental and social responsibility as well as good governance.
Examples like the Volkswagen emissions scandal show that companies are being held accountable.
ESG is becoming mainstream, and the authors believe it's only going to get bigger.
So are they saying it's not just a fad?
No, they see it as a fundamental shift in how we think about business and investing.
And a key aspect of this, especially in emerging markets, is governance. The authors stress that it's the cornerstone of everything.
They outline 4 key principles: fairness, openness, alignment, and adherence to rules.
Ensuring companies are managed responsibly with the interests of all stakeholders in mind.
Exactly, and the authors believe these principles can have a positive ripple effect beyond the corporate world.
Contributing to broader societal progress?
They point to Georgia's Public Service Hall with its transparent design as a symbol of this vision.
So even in countries with a history of corruption, change is possible.
That's the message they're trying to convey.
Speaking of regions with complex histories, the authors challenge the prevailing pessimism about Africa's future.
They see the continent's growing population and vast potential as a compelling investment opportunity.
So they're bullish on Africa.
They believe Africa is poised for significant growth and development while acknowledging the challenges, poverty, inequality, corruption, conflict.
Right, it's not a simple story.
But they argue that ESG investing can be a crucial tool in helping Africa reach its potential.
While addressing these challenges.
Exactly. And they urge investors to look beyond the headlines and recognize the real opportunities that exist.
So it's about seeing the potential, not just the problems.
Right. As we wrap up this part of our deep dive, let's bring it back to that core message of investing for good. It's not just about maximizing returns, it's about using your resources to make a positive impact.
It's about recognizing that ESG factors are essential for long-term value creation.
And it's about embracing a holistic approach to investing that considers the well-being of people and the planet alongside financial performance.
So before we move on to the final part, we want to leave you with another thought. If you could invest in anything that would make the world a better place, what would it be? Think on that, and we'll pick up the thread in part 3 of our ESG deep dive.
Yeah.
Welcome back to the deep dive. We've been exploring ESG investing with Invest for Good.
And that question we left you with, what would you invest in to make the world a better place?
It's a big one, right?
It is, but, the authors, they highlight that it doesn't always have to be these massive, world-changing initiatives.
Yeah, sometimes it's those smaller, under-the-radar companies that can make a surprising impact.
They tell this story about a company in Romania that was really struggling to attract foreign investment.
Oh, yeah. What was it they made?
I don't recall the specifics, but they had a decent business, but their corporate governance was a mess.
Like really bad.
Oh, yeah. Turns out there were all sorts of shady things happening, hidden pipelines, illegal waste dumping, you name it.
Wow. So like a real ethical nightmare?
Pretty much. But here's where it gets interesting. They actually brought in a former Stasi agent to investigate.
Wait, seriously, a Stasi agent?
That's the one sounds crazy, right?
Yeah, kinda.
But he uncovered all this corruption, and with new management, the company took steps to clean up its act.
So they owned up to their mistakes.
Exactly. They embraced transparency instead of trying to hide things.
And how did that go over?
Surprisingly well, they were actually praised for their honesty and commitment to fixing things.
So good governance became a selling point.
It did. It actually enhanced their reputation and made them more attractive to investors.
That's pretty counterintuitive.
It is. It shows that ESG isn't just about checking boxes. It's about creating a culture of integrity.
And that culture can spread, right?
Absolutely. It can influence not just the company, but its partners, suppliers, and even the community around it.
So it's like a ripple effect.
Exactly. The authors argue that companies embracing good governance contribute to a more ethical and equitable business environment as a whole.
So they're raising the bar for everyone.
They point to Nigeria as an example. Despite the challenges of corruption and poverty, there's this vibrant entrepreneurial spirit.
Yeah, I heard about that.
And they highlight a growing number of companies in emerging markets adopting international best practices.
That's encouraging to see.
It is, but the authors also remind us that, progress isn't always linear.
There will be bumps along the way.
Exactly. There will be setbacks, scandals, moments of disillusionment. It's not all sunshine and roses.
That's for sure.
But they remain optimistic about the future of ESG investing. They see this growing awareness among investors, consumers, even policymakers.
That ESG factors are actually material to long-term value.
Right. They envision a future where sustainability and profitability aren't at odds with each other.
But rather, two sides of the same coin.
Exactly. So where does this leave us? What can we do as individuals to invest for good?
Yeah, that's the big question.
Well, the authors offer some practical advice first. Do your homework.
Don't just take things at face value.
Right. Dig into the details of a company's ESG performance.
Look beyond the numbers. Consider their impact on the environment, their workers, the communities they operate in.
Exactly. Second, engage.
Use your voice.
As shareholders, we have a voice context. Ask tough questions, demand transparency, hold companies accountable.
And if you're not happy with what you see, vote with your wallet.
Divest from companies that don't align with your values and invest in those that do.
Put your money where your mouth is.
Exactly. And finally, support organizations that are driving positive change.
Yeah, there are so many great nonprofits, think tanks, advocacy groups out there.
Whether it's through donations, volunteering, or just spreading awareness, we can all play a part.
So it's not just about investing our money, it's about investing our time and energy as well.
The authors leave us with this thought: investing for good isn't just about making money, it's about making a difference.
It's about using our resources to create a world where prosperity and sustainability go hand in hand.
And that's a world worth investing in.
Couldn't agree more. Well, that's it for our deep dive into ESG investing with Invest for Good. Thanks for joining us.
We hope this has sparked some new ideas and inspired you to invest for good in your own way.
Until next time, keep diving deep.
Thank you all for listening. For more learning, click the link below the video and description section. Also, if you like these types of videos, hit like and subscribe bottom to see more videos.